Crypto may finally be going mainstream, spurred in part by the billion-dollar public debut of Circle, the issuer of stablecoin USDC, and the passage of the stablecoin legislation drafted by the Senate, dubbed the Genius Act.
The yeas are 68, the nays are 30. The bill as amended is passed.
Big finance players are getting in on the action.
Coinbase, which earns half of the revenue generated by USDC, launched a new partnership with payment platform Stripe and e-commerce giant Shopify to bring USDC payments to merchants around the world.
JP Morgan announced its own stablecoin-like product called JPMD. Payments firm Fiserv announced a stablecoin to pair with the 90 billion transactions that it processes every year.
And even Walmart and Amazon are reportedly looking into their own tokens. Treasury Secretary Scott Bessent says the launch of these dollar-pegged stablecoins could unlock a $2 trillion market.
We are a payments company, and we saw the potential of this technology to bring the next generation of payment rails. We didn't know whether it was going to play out or not, but it was absolutely too important for a payments company not to have a horse in the race.
Cards were this whole new money movement platform that were created many decades ago, and they've created trillions of new economic value, and we think that stablecoins will do the same.
But there are some who believe that these products aren't ready for prime time. Crypto is still fending off an industry-wide reckoning. There are concerns that the rise of stablecoins risk the financial system's stability, and these digital dollars lock consumers out of lucrative interest payments because stablecoins aren't allowed to pay yield. So why are some of the biggest companies in the world going all in on their own crypto tokens? Stablecoins are cryptocurrencies that aim to do exactly what their name suggests: remain stable. Unlike Bitcoin, which garners investor attention for its huge up and downside, or NFTs, which often rise in price based on hype alone, stablecoins are pegged to the price of another asset. And in many cases, that's the US dollar.
That digital representation of a dollar, you can move around between two different wallets, two different entities, two different businesses in any jurisdiction in the world.
Stablecoins are able to keep that $1 peg because they hold reserves of real dollars or cash equivalents like US Treasuries. Those reserves are intended to match the amount of the stablecoin in circulation. Circle's USDC and Tether's USDT are the biggest stablecoins by far, with a combined $217 billion in circulation.
Tether is located in El Salvador. They are targeting global customers, not in the United States in this case. But Circle, located in the United States, in New York, they are under the New York regulatory umbrella, and they are targeting to United States customers.
Now, proponents of these tokens say they have the potential to overhaul the global financial system. Right now, transactions can take days to complete, but stablecoins could settle payments instantly, day or night, thanks to the blockchain.
But here in the US, adoption of stablecoins has been slow. Many people don't really notice if their payment on the card is processing for a few days. PayPal, Venmo, and Cash App provide sort of instant transfers for consumers, even if it really takes days for that money to change hands for the company.
A barrier to access to stablecoins is very low, and this gives unbanked communities, people, an opportunity to receive, save, and spend US dollars without a bank account.
These tokens could allow cheap transactions across borders, and many people in emerging markets are already using stablecoins as an alternative to volatile local currencies.
But here in the US, adoption of stablecoins has been slow.
You can see today people who are sending money to their loved ones abroad, and they're using stablecoins to fund those remittances and avoid any transaction fees. But you're also going to see stablecoin use cases that are in the water supply, that are infrastructure and that are abstracted from the consumer. Many of the users out there today are not aware of stablecoins or not interested in stablecoins, and they should not be. It should just be a way in which you move value, and in many cases, it's going to be an infrastructure layer.
Corporations, however, see big potential for stablecoins. The IPO Circle, which is the issuer of USDC, unlocked billions of dollars in pent-up demand for these issuers. After raising $1.1 billion during its debut on June 5th, the company's stock soared more than 700% just in June. Then, new Circle partnerships and competition quickly followed. A stablecoin product launches from crypto exchange Coinbase, Shopify, French bank Société Générale, and payments platform Fiserv quickly hit the headlines.
We're entering the utility phase right now, where the technology has matured. It's gotten fast, it's gotten cheap, it's gotten easy to use, and that's leading to real-world adoption across businesses and consumers. And stablecoins are at the forefront of it.
These announcements all touted the same benefits for companies: faster payments, the ability to transact 24/7. But corporations are also looking to stablecoins to cut costs. One big area for savings: payment processing fees. Card issuers raked in a record $187 billion in transaction fees in 2024, according to Nielsen. Now, companies issuing their own tokens could decimate those fees if they can convince consumers to transact in dollar-pegged tokens instead. In fact, when the Wall Street Journal reported in June that Walmart and Amazon were considering their own stablecoins to cut down on fees, Visa, MasterCard, and American Express all saw their stocks slide.
Maybe the market fears that the interchange revenue will be disrupted, but people like credit cards. They like rewards programs. They like points. So I don't think that's going away. Maybe there will be some disruption, but as far as I can tell, Visa and MasterCard are leading into the disruption. They're trying to disrupt themselves. So they seem to be ahead of the curve here.
Visa told CNBC that it's embracing stablecoins.
We've been enabling people to issue Visa credentials on top of stablecoins. We've been modernizing our own settlement infrastructure with stablecoins. And we have a whole host of innovations that we plan to deploy around the world embracing stablecoins.
Not to be left behind, MasterCard announced that it was enabling multiple stablecoin transactions on its token network with the help of stablecoin issuer Paxos. And then there's the idea that stablecoins could speed up the financial system. JP Morgan announced its JPMD deposit token. The bank said it's similar to a stablecoin, but rather than representing $1, the coin represents a commercial bank deposit. Now, it's limited to institutions, but it offers round-the-clock settlement. Right now, banks pay a roughly 4.3% fee to get funds from the Fed overnight, and many transactions can't happen overnight at all.
JP Morgan told CNBC the new offering allows clients to move money around faster, earn interest, and still keep a close tie to the traditional financial system.
But as TradFi quickly embraces these crypto tokens, some are raising alarm bells about the risks. 2023's banking crisis didn't just expose cracks in the traditional financial system, it also hit stablecoins. When Silicon Valley Bank collapsed in March, Circle's USDC lost its peg to the US dollar.
So what happened to USDC? Well, its issuer Circle said that it had $3.3 billion worth of cash parked with the now collapsed Silicon Valley Bank. And as a result, this is what happened, a massive depeg.
When the Federal Reserve Bank of Boston convened to explore the implications of stablecoins on financial stability, William Birdthistle, former SEC director of the Division of Investment Management, compared stablecoins to money market funds. He said that in the worst runs on those kind of funds, investors only lost a penny or two on the dollar. But stablecoins, those could fall to zero. Now, the industry saw this with the collapse of the Terra USD stablecoin in 2022. That event snowballed into a total crash of the crypto market as investment firms went under and crypto exchanges went bankrupt. There's also money laundering risks. A report from the US Treasury in 2021 found illicit finance concerns with stablecoins, particularly giving bad actors the ability to skirt sanctions and anti-money laundering rules.
Previous administration of the United States made it very difficult. Senator Warren sent letters to the auditors basically suggesting that they should not touch crypto companies. And the OCC was very against crypto companies. Banks were not banking crypto companies.
Now, crypto's major collapse and rise in criminal activity made Congress sit up and pay attention. Now, lawmakers are hoping to pass the first major regulation to solve some of the problems that stablecoins exposed. The Senate's advance of its stablecoin regulation, the Genius Act, was applauded by both crypto businesses and regulators.
We've been embracing and building for years, preparing for this moment. The Genius Act has now passed the Senate, as you know, and is expected to pass the House. I think that'll give regulatory clarity to stablecoins.
The bill contains key provisions: protections for consumers, reserve and annual audit requirements for token issuers, and it lets the Treasury Department designate foreign stablecoin issuers as non-compliant. The bill passed with bipartisan support and now heads to the House, which has been working on its own stablecoin framework. But the Genius Act still doesn't answer some key questions about what these companies owe their customers who hold on to their stablecoins. Now, under the bill, issuers are banned from providing yield to their customers. So unlike a bank account where you would earn interest on your balance, however small that interest might be, stablecoin issuers would simply pocket that yield rather than paying it out to you, or find a creative kickback-like rewards.
They'll call it something else. They won't call it interest payments. They won't be able to. But we will see a lot of these models develop where there is that 4.5% yield.
Now, Senate Democrats like Massachusetts Senator Elizabeth Warren also warned the bill doesn't do enough to address potential conflicts of interest with President Trump and World Liberty Financial's stablecoin that launched this year, USD1. Now, she pointed to an investment from a United Arab Emirates firm into that stablecoin as a particular pain point. The Senate Banking Committee argues the Genius Act makes it clear that ethics laws apply to members of Congress and senior executives in the government. And when asked about the president's ties to crypto projects in his name, the White House told CNBC there are no conflicts of interest and that President Trump's assets are in a trust managed by his children. The president has urged Congress to send the bill to his desk, calling digital assets the future.
I think it was a mistake for Trump to have a Trump-affiliated DeFi project issue a stablecoin. I think that really set back his stablecoin legislative agenda. I think we could do it a lot more in terms of tackling these conflicts of interest, and I completely understand the Democrats when they try and weed this out. You know, they should be in the business of creating sound legislation, regulation, not trying to enrich themselves via the industry that they're regulating. So I'm very sympathetic to those COI concerns.
Now, when testifying before Congress, Treasury Secretary Scott Bessent said that stablecoins could become a $2 trillion business. And as lawmakers debate the big, beautiful budget proposal and what it means for the nation's skyrocketing debt, Secretary Bessent also said that stablecoins could unlock a way to manage the deficit. Now, Bessent sees a world where the rise of stablecoins from American corporate giants could mean a boon for the U.S. Treasury market, which could lower the cost for the United States to borrow money.
We know that China and Japan, the top two foreign holders of US treasuries, are net sellers, not buyers, in 2024. However, stablecoins issuers are in the top 10 buyers as a total of US treasuries in 2024. This will only increase because the demand for stablecoins has been decoupled from the crypto market cycle. Problem is that the United States have to issue treasuries to refinance the debt. Who's going to buy those treasuries? Now we have a new buyer. This is not the top buyer. This is not going to save the US debt problem, obviously, but that's going to alleviate the problem.